Happy Saturday out there, Team 42. It's your skipper here, Darius Dale, to present Around the Horn for Saturday, November 4th, 2023. Hope everyone's having a great weekend. We'll try to get you out of here pretty quick so you can get back to enjoying some college football. We'll start with our executive summary here on slide three. Number one, on the heels of a plethora of dovish global macro policy catalysts that we accurately presaged, asset markets staged their biggest relief rally since November of 2022. For example, the 60/40 portfolio was up 4.3% week over week. Our medium term quantitative risk management signals currently see an extreme underweight in stocks by discretionary investors, the likes of which is typically only observed at major bear market bottoms in the stock market. My 15 years of experience on global Wall Street lead me to conclude when sentiment gets this extreme in either direction, it pays to take the other side for a trade. Number two, that means bears should give this cross asset relief rally some time to breathe, especially in the context of dramatically improving non-farm productivity dynamics that may ignite renewed interest in soft landing trades among investors. In terms of aggregated cross-asset positioning signal, the thing I call out is what I called out earlier in the presentation is the AAII bulls bears. We're at 9 percentile bulls reading with the 96th percentile of the 96th percentile of the bears reading, and we're only in the fourth percentile in terms of the bulls bear spread. And so that's indicating we are an extreme underweight for discretionary investor positioning, using this as a proxy for that particular indicator. And how we know that is that when you go back and you look at the levels of these particular indicators featured in this chart at major S&P bear market troughs, December 87, October 1990, September 1998, March 2003, March 2009, October 2011, December 2018, March 2020, and October 2022, and you look at the median value of these particular indicators at these troughs, the AI Bulls Bear spread is actually the ninth percentile of these troughs. We are in the fourth percentile. So we're lower than the median value at major bear market troughs. And we called this out in real time, I want to say on Wednesday, and said, hey, this market run, be careful to the upside, be careful bears shortening into this. And obviously we got the river card on Friday in terms of the jobs report that really got things explosively higher to end the week. And this condition persists. So, as long as this condition persists, I do believe that there's some short-term tactical upside in risk assets and in the bond market in the context of this, kind of Goldilocks feel that has created this this aggressive short covering exercise. So getting into, in terms of our qualitative research here, this week's key macro event was an enchanted week for the U.S. Treasury bond market. So on Tuesday, we got a dovish BOJ surprise. On Wednesday, we got a dovish Q4 quarterly refunding surprise. On Wednesday, we got a Q3 non-farm productivity beat. We got a mixed September JOLTS report on Wednesday as well. We got ADP payrolls miss on Wednesday and a slowdown in their median annual pay statistic. On Thursday, jobless claims signaled a higher probability of a near-term recession. On Friday, October jobs report signaled a welcome cooling of the labor market. And lastly, Thursday, the October jobs report signaled a higher probability of a near-term recession. So let's unpack these data. Starting with Tuesday, the BOJ spared the JGB market from expectations of faster policy normalization. All they did was a tiny tweak in the yield curve control framework. Instead of using 1% as a hard cap to defend in terms of their unlimited unscheduled bond purchases, they're using it sort of as a reference rate. So they may start to do incremental QE above 1%. So they'll allow market kind of find a natural higher level of yields beyond 1%. But when I asked if he saw yields getting to 1.5 or 2% on the 10-year JGB, Kuroda said that was a hard no for him. So we know that the level is not much higher than 1% in terms of incremental BOJ balance sheet expansion, which has been somewhat muted relative to the big spike that we saw in Q4 and Q1 earlier this year. But clearly the fact that they're one of the few major central banks actually supplying liquidity to the market alongside the PBOC here, the reason they're doing that is to defend that yield curve control framework. So as long as they don't make any significant revisions to want that yield cap, it's unlikely that we see a significant pullback in support for the JGB market by the Bank of Japan, which is waiting for Godot on signs of a wage price spiral, which may not come until next spring's wage negotiations. Wednesday, Yellen continued to flood the market with T-bills to tap into excess demand via the Fed's reverse repo facility balance, which has about $1.1 trillion in it. So we got the Q4 quarterly refunding announcement. Yellen continues to starve the market in terms of flooding the market with T-bills, way more T-bills in terms of coupons, in terms of supply, which is anomalous relative to history. On a trailing 12-month basis, net coupon issuance will account for 27% of net marketable borrowing through Q1, which is the lowest ratio we've seen since at least 1Q18. So the red bars is the 12-month coupons divided by net marketable borrowing ratio. And again, we're trending all the way down to 27% by the end of Q4, or sorry, by the end of Q1 of 2024. So that again would be the lowest level in this chart. And again, this kind of 60 to 70, percent range of bills divided by net market borrowing is very rare. You typically, we saw that kind of in the response to COVID when the government was just pumping money into everyone's checking accounts, corporations and households included. And so the Yellen is sort of taking that same approach here amid the backup in long interest rates, and obviously the excess demand for T-bills that we can imminently see and observe in the reverse repo facility balance. Net nominal bond issuance will total 324 billion in the 2 quarters through Q1, which is well shy of the 420 billion mean in the 2 years through the second quarter of 2022. So again, if you take it on a trailing 2 quarter sum basis, this is bond issuance. So this red bars in these previous two charts are coupon issuance. So anything coupon is anything beyond a 12-month T-bill all the way through the long end of the curve, 30-year Treasury curve. Bonds are 10 years and above. And so, in terms of targeting the long end of the Treasury coupon curve, that the Treasury Secretary Yellen is guiding to 324 billion in the 2 quarters through the first quarter of 2024. That's around about 70% of net coupon issuance, but just in terms of the aggregate, kind of a nominal level of that, it's well shy of this kind of big bolus of coupon issuance here from 3Q20 all the way through kind of the middle of 2022. So we're still in a low bond supply regime and will remain in a low bond supply regime through the first quarter of next year. But again, we're now starting to gradually creep up. And again, these numbers aren't going anywhere. We're not going back to this. We see the CBO projections, which we continue to encourage investors to hammer the over on in the context of our fourth turning and empirical analysis, which I believe is some seminal work, not only just in my career, but I think once you've had a chance to review that, you'll agree that some of the best research you've seen in your own careers, if I do say so myself. But getting back to the enchanted week for the U.S. Treasury bond market, Wednesday we had a sharp acceleration in productivity growth and increased the consensus assessment of the probability of a sharp soft landing. So big pop in productivity growth from basically 1% to 2.2% on a year-over-year basis. If sustained, the acceleration in non-farm productivity improves the near-term outlook for inflation. That's a big if, though. So what we're showing here in this blue line is private sector average hourly earnings minus non-farm productivity, showing that on a spread basis. And so as that spread declines, it allows inflation to decline because the need to pass on price increases to consumers, particularly on the unit labor cost front, is lessened amongst corporations. And so what you find historically is when you see this blue line spike, historically, it typically is accompanied by big spikes in inflation, because again, that's companies going, man, what I'm paying my workers is growing much faster than the productivity, their speed with which they're growing incremental goods and services, and from a supply of goods and services perspective. And as long as that remains the case, the only way to protect your margins in that scenario as a corporation is to pass on those price increases to consumers. And so as long as the blue line continues to go down, you should expect the red line and black line to continue to go down. But again, that was a massive pop in productivity growth. And then in sustaining 2.2% productivity growth is a huge if in the context of the long-term trend in productivity. Going back to this previous chart here, what you see is that we show the 5-year, 10-year, and 40-year averages of year-over-year non-farm productivity growth, and it's all somewhere around 1.5%. So let me say that again. The 5-year average for productivity growth is around 1.5%. The 10-year average for U.S. productivity growth is somewhere around 1.5%. And the 20-year average for non-farm productivity growth is somewhere around 1.5%. So this is in the context of a lot of cool stuff on the internet front, right? We got companies like Amazon and Google and Facebook or whatever they call themselves now, Meta, Tesla, have all come out and done some amazing things in the last 20 years, and non-farm productivity growth has coalesced around 1.5%. And so expecting something like generative AI or something, I don't know, whatever else it is, Ozempic maybe, to create a significantly more productivity growth in the U.S. economy, maybe transitorily it does, in terms of you've seen these big spikes in the chart previously. But on a long-term trend basis, we are somewhere around 1.5%. So to expect more productivity growth beyond that requires some very aggressive assumptions that we just don't see in the context of the data. Oh, sorry, actually, no, my apologies. I did mistake that earlier. This is 5 years, 10 years, and sorry, 10 years, 5 years, 10 years, 20 years, and 40 years. So it's a long-term time series of productivity. Anyway, let's keep it moving here. Wednesday, the September jobs report was mixed, but continues to point to a slower wage growth over the medium term. So in terms of mixed, the jobs total unemployed ratio remained elevated at 1.5, so it continues to a structurally tight labor market from a supply demand perspective. But we also held in terms of these sort of more benign levels that we achieved in the most recent month in the August jobs report, in terms of the hires rate, stuck at 4.1%. The private sector quits rate stuck at 2.6%. And the reason that was positive is because workers that change jobs experience faster wage growth than workers that don't. So less turnover in the labor market should slow the pace of wage growth overall, the aggregate pace of wage growth, and that reduces the probability of incremental tightening. And so that's exactly what we got in terms of the Atlanta Fed wage trackers. The blue line is the job changers. The dotted lines indicate the long-term mean of the time series. And so as long as the blue lines in these charts continue to go down, we should have slower wage growth. And that's a function of, again, a more normal level of turnover relative to where we had been trending in recent years.